So profitability analysis is going to evaluate how well a company can generate future earnings. So how able are they to generate future earnings? So this ability depends on the relationship between the company's operating results and the assets the company has available for use. The relationship between income statement and balance sheet items are going to be used. Income statement for the operations part, and then assets are going to be on the balance sheet. So here are the ratios we're going to look at. So let's just go ahead and look at some of these. Asset turnover is how effectively a company uses its assets. And so this is what you're going to do. You're going to do sales divided by average total assets. So sales is going to come off of your income statement, average total assets. You're going to take the beginning year total assets and the ending year, and you're going to add those and divide by 2 to get your average. So here is where we have worked one. We have our sales from our income statement. We have our beginning and ending year balances for assets, total assets. Add those together, divide by 2 to get your average total assets. Okay, and you're going to do sales divided by your average, and you're going to get 1.3 and 1.0. So for our current year, on average, the asset turnover ratio is 1.3 times. Here's an example exercise to work and to check, and we'll keep moving. So the next one is the return on total assets. So it measures how profitable total assets are without considering how their assets are being financed. This rate is not affected by the portion of assets financed by creditors or stockholders. We don't care how it's financed. We just want the return on it. How well are we doing with the assets that we have? So you're going to take income plus interest expense, and then you're going to divide it by your average total assets. So you're going to get interest plus interest expense from the income statement, and you're going to get average total assets by looking at the balance sheet. So if it takes a lot of assets to earn profit, then it might not be a good number. So let's look here. We're going to get this from the income statement, this from the balance sheet. Okay, take your average, get your average total assets. So net income with interest expense added back, divided by your average total assets. So it's a little bit higher here than it was in the previous year, but we would want to compare that to the industry too. You also have to think about what kind of company it is, okay? Because this might be different depending on what we're making. Like if we have a lot of assets, a lot of total assets that we use in the business to turn a profit, it may be a bit different. So this is why it's so important to compare this percentage to the industry. Return on total assets is computed when there are large amounts of non-operating income. So if you have a lot of non-operating income, you may want to calculate this ratio, which is your income from operations divided by your average operating assets. Okay, so a company reports the following income statement, determine the return on total assets. This is an example exercise that you can work. and then check. Okay, return on stockholders' equity is going to tell us the rate of income earned on the amount invested by stockholders. So you're going to take net income from the income statement and then average total stockholders' equity. So here we got our net income, we have our beginning year and our ending year stockholders' equity. Once you use your formula, you get a return of 11.3% here and 10% here. So we have a higher return this year, but we'd also want to compare that to the industry. Now, who would be interested in this ratio? Stockholders, your investors, someone that bought company stock would be very interested in this. Okay, so it's giving us the return that stockholders get when they invest. Okay, the return on stockholders' equity is normally higher than the return on total assets because this is called leverage, and what we do is we use debt to increase the return on investment. So we can look at the effect of leverage here. Here's the return on stockholders' equity, 11.3%, minus the return on total assets, and this is how much leverage we have, 3.1%. Okay. So you can see here in year 2016 and then 2015, this is a better way to look at it. You can see the leverage effect. We have a little bit of leverage here because our return on the stockholders' equity is higher than the return on the total assets. The difference is called leverage. Now we're going to look at the return on common stockholders' equity. So this is the profits earned on the amount invested by common stockholders. So that is why we want to subtract out preferred dividends, because preferred stockholders rank ahead of the common stockholders in their claim to earnings. So what's left over after their dividends are paid is what can be handed to the common stockholders, and you're going to divide it by the average common stockholders' equity. So here they have $150,000 par value of 6% preferred stock. The preferred dividends, you remember you can calculate 150,000 times 6% would give you the preferred dividends, and we're going to deduct those from net income. Okay, and then here is the common stockholders' equity. It's your common stock plus your retained earnings. That's how you get your common stockholders' equity. So the key word in this is common. So you take net income, subtract out your preferred dividends, and that will be the 82,000 will be your total. Okay, your total numerator. Then you take beginning and ending your stockholders' equity, divide by 2 to get your average. So our return is higher than last year, so that is a good thing for common stockholders. But we would want to compare that to the industry to see, are we as a stockholder, am I doing as well as the industry average? Okay, so it says Lincoln's return on common stockholders' equity, if you see that, is, well, I can't write on it. Let me see if I can do it this way. Okay, its return, let's look at 2016. Its return on common stockholders' equity is different from the return on total assets and return on stockholders' equity, and the reason is because of leverage. Here's an example exercise that you can work and check your answers. Earnings per share measures the share of profits that are earned for each share of common stock. So you're going to take net income, subtract out preferred dividends because it's not going to go to common stockholders, and divide by the shares of common stock outstanding. When preferred and common stock are outstanding, preferred dividends are subtracted. If you have preferred stock, you're going to subtract out dividends. If you don't have preferred stock, then there will be nothing to subtract out. So here it is, net income minus preferred dividends. Divide that by the shares of common stock outstanding to get your earnings per share. So common stockholders are earning more per share this year than last year. Of course, you would want to compare it to the industry average too. Okay, many corporations have complex capital structures and they have different types of equity. They may have convertible preferred stock, stock options, stock warrants. Okay, in such cases, the possible effects of such securities are reported separately as earnings per common share, assuming dilution or diluted earnings per share. So these are all different scenarios that I really don't want to get too deep in. All I want you to know is how to calculate earnings per share of common stock. Price earnings ratio. You're going to take the market price per share of common stock and divide it by the earnings per share. Earnings per share on common stock we just calculated. So remember, market price is what the stock is, the market value of the stock at that moment, which would be given to you. Earnings per share on common stock is just the net income earned per share of stock. Net income less the preferred dividends if you have any of those. So here's an example. They're giving you the market price. We calculated the earnings per share. So the price earnings ratio for 2016 is 25. The increase from 20 to 25 indicates that the market expects Lincoln to experience favorable earnings in the future, because the price earnings ratio is increasing and the market price is going up, so that shows you too a favorable trend. Here's an example exercise for you to work and check. Dividends per share. Just take your dividends on your common stock and divide it by the shares of common stock outstanding. So this just tells us the extent to which earnings are being distributed to common shareholders. So common shareholders would be very interested in that. Here's one where it's worked. So you can see that dividends per share were 60%. It's gone up to 80%. So common stockholders are getting more dividends per share of stock that they own. Okay, and you can compare the earnings to the dividends. Notice that when the earnings were higher, common stockholders, their earnings per share was higher. The dividends per share was higher because they have more to distribute. Then you have the dividend yield, which is the dividends per share of common stock divided by the market price per share of common stock. And here is an illustration of that. And that's it. Let me know if you have any questions.